A single, highly coordinated strike can change everything. Reports say a U.S.-Israel operation this week targeted Iran's leadership, and in the hours that followed, the region lit up. Missile and drone salvos, air defenses firing, commercial targets hit, and one of the world's largest refineries struck. Markets reacted in minutes. Oil and shipping costs spiked. The immediate question is simple: what ignited this, and could the fallout reach other countries? In this video, I'll explain the trigger, map the mechanisms that turn regional violence into global economic pain, and show what that means for investors and ordinary citizens, including a focused case study on Brazil.
Within minutes of the reported strike, multiple things happened at once. Air defenses were engaged over Israel. Missiles and drones were tracked, heading towards several states across the Gulf. Reports describe attacks or attempted strikes in 6 countries beyond Israel, from the Gulf Sheikdoms to Iraq and Jordan, and an incident at Ras Tanura, one of Saudi Arabia's most important oil export terminals. Tanker routes saw disruption, and some operators paused sailings through high-risk areas.
Insurance premiums and freight rates rose almost immediately. Those are the tactical, observable consequences. What we need to do next is connect those dots. How did a single operation ripple into threats to oil flows, insurance costs, and ultimately prices at the pump? If this analysis matters to you and you want more data-driven breakdowns on geopolitics and markets, please like and subscribe. I'll keep these explanations practical and evidence-focused. To understand what happened on the ground, it helps to visualize the military technique often described as time on target. Rather than sequential strikes that give defenses time to react, time on target means multiple platforms, aircraft, surface vessels, submarines, missiles, deliver effects against a target or set of targets in a very narrow window. The goal is to overwhelm layered defenses and create simultaneous dilemmas for the opponent. In this case, reporting suggests coordinated naval, air, and perhaps subsurface activity were used to strike high-value leadership nodes and infrastructure. That coordination is what turned a single action into a broad, multi-country response almost immediately. At the center of the accounts is the reported targeting of Iran's top leadership. I'll stress this: any claim about a leader being killed or captured needs independent confirmation. As of now, sources describe the operation as aimed at leadership, with varying reports on outcomes. Treat those claims as reported, not confirmed, until vetted by reliable authorities. What we can say with more certainty is that after the operation, Iran's regional network and its proxies and allied militias accelerated attacks against partners of the United States and Israel. We saw missile and drone salvos over Israel, strikes and attempted strikes against Gulf states and facilities, and an attack that damaged or threatened Ras Tanura. Strait of Hormuz traffic experienced harassment and temporary rerouting. Those are the immediate tactical consequences. Next, the strategic and economic consequences. Why do these military moves matter to global markets? The answer is choke points and perceptions. The Strait of Hormuz is not a symbolic waterway, it is a real economic artery. Roughly 1/5 of seaborne oil flows pass through that narrow channel. If traffic is disrupted, whether by mined waters, attacks on tankers, or an effective harassment campaign, the immediate effect is a tightening of available seaborne supply. Oil doesn't have to stop flowing entirely for prices to move. It only takes market participants pricing in a higher risk premium, insurers raising war risk cover, and charter rates jumping for large tankers. Freight costs rise, inventories fall, and the price signal travels quickly from Middle Eastern bunkers to the pumps in cities around the world. In this episode's market moves, we saw the same dynamic play out. Reported spikes in oil contracts and sharp increases in freight futures as operators and insurers repriced risk. Those moves ranged from single-digit to low double-digit % changes in some contracts and routes, depending on the market and the contract's liquidity. Freight and war risk insurance effects were immediate. Tanker rates climbed as insurers raised premiums, and some owners rerouted around higher-risk corridors, adding time and fuel costs to shipments. The practical upshot is that energy costs rose for consumers and businesses very quickly, and central banks, always sensitive to inflation, started recalculating the outlook. These immediate events are dramatic, but they sit on a long history. To make sense of why a strike on Iran's leadership would trigger such far-reaching responses, we need a compact timeline of the modern turning points. Start in 1951. Mohammad Mossadegh, Iran's prime minister, nationalized the oil industry, a move that threatened Western oil interests. 2 years later, in 1953, a coup removed Mossadegh and restored greater power to the Shah, an event with deep and lasting political consequences for Tehran's relationship with the West. Fast forward to 1979, the Islamic Revolution overthrew the Shah and brought Ayatollah Khomeini to power, transforming Iran from a pro-Western monarchy into an Islamic republic with an ideological foreign policy. The 1980s saw the Iran-Iraq War, a brutal conflict that left deep regional scars and hardened Iran's sense of strategic vulnerability. Then, in 2003, the U.S.-led invasion of Iraq removed a regional balance point and over time allowed Iran to expand influence across Iraq and into Lebanon, Syria, and Yemen through a network of allied groups often referred to as the Axis of Resistance, or the Shia Crescent. Each of these events built the incentives and structures that make Iran both wary and capable of projecting power around the Gulf. That projection is not random. Iran's foreign policy uses a mix of state actors and proxy groups to create multiple deterrence layers. By supporting militias and political movements across the Levant and the Gulf, Tehran raises the cost of hostile action against the regime. Any direct strike inside Iran risks triggering asymmetric responses abroad. From Tehran's perspective, this network is insurance. From Israel's and the U.S. As perspective, those same networks present a strategic problem. They extend Iran's reach and make it harder to neutralize threats without wide collateral effects. So when a strike appears to target leadership, Iran's response can be geographic and indirect, hitting partners and assets in countries tied to the U.S. or Israel, damaging industrial targets, and using harassment in maritime choke points to inflict economic pain. At the same time, great power dynamics deepen the stakes. China has been expanding economic and strategic ties with Iran for years. Iran plays a role in parts of the Belt and Road framework and serves as an energy partner for Beijing. Crucially, China has invested in strategic oil stockpiles and has increasingly purchased sanctioned or discounted Iranian barrels. That accumulation means Beijing has some short-run resilience to sudden supply shocks. If oil flows through Hormuz dip for a few days, China's inventories and alternative supply channels can blunt the immediate price spike that would otherwise send the market into a deeper panic. From the U.S. perspective, any action that weakens Iran's operational posture or degrades its command and control capabilities serves a broader objective, containing Iran's regional influence and protecting allies. But this is not only about Iran versus the West, it is also about the competition between the U.S. and China. Every disruption to energy trade, every hit on a refinery, and every rise in freight costs becomes another variable in a larger strategic contest. Who can withstand shocks, who can secure alternative supply routes, and which capital markets absorb risk more effectively? That elevates a local conflict into a systemic risk factor. So how does an event like this transmit to other countries? There are mechanisms and pathways we can trace. First, direct strikes and proxy attacks hit neighbors. We saw missiles and drones over Israel and across multiple Gulf countries. Attacks on infrastructure, refineries, ports, and hotels frequented by business travelers damage the physical economy and raise immediate reconstruction and security costs. Second, choke points amplify effect. The Strait of Hormuz is a single bottleneck that, if partially closed or perceived as unsafe, forces rerouting around Africa's Cape of Good Hope, a change that adds days, fuel, and cost to shipments. Those extra costs show up in higher prices for refined products and heating fuels globally. Third, insurance and freight costs impose second-round effects. When marine insurers price war risk higher, all shipping through the region becomes more expensive. That increases the landed cost of goods, pushes inflation up, and complicates central bank calculations. Insurance friction is a less visible but very real transmission mechanism. Fourth, market psychology and uncertainty cause capital to reprice risk. Investors pull back from assets tied to growth or trade exposure, while safe haven flows push up yields for certain currencies and sovereign bonds. Commodity traders react quickly, which feeds back into corporate input costs and consumer prices. Now let's look at the countries most immediately affected, and then I'll walk through a focused case study: Brazil. Regionally, the Gulf states, Saudi Arabia, the UAE, Bahrain, Kuwait, Qatar, are directly exposed both physically and economically. Their infrastructure and financial systems are entangled with global energy markets. A strike at Ras Tanura, even if isolated, raises questions about export continuity. Iraq and Jordan face direct security threats from proxy groups.
Both host U.S. forces and allied bases, making them potential arenas for escalation.
Lebanon and Syria remain volatile due to long-standing proxy relationships with Iran. Beyond the immediate theater, any major disruption to oil flows raises global prices and insurance costs, which in turn affects energy-importing countries, trade-dependent economies, and inflation readiness worldwide. Turning to Brazil, why should a country across the ocean care? There are 4 concrete ways the shock transmits to Brazil's economy and financial system. First, export revenues. Brazil is a major commodity exporter. In a higher oil price environment, the terms of trade can shift in Brazil's favor for some products while raising costs for others. As an estimate, a 10% rise in oil prices has been modeled to increase Brazil's GDP by roughly $4 billion, factoring in energy-related export and valuation effects. Treat that number as a model estimate and not a guaranteed outcome. It simply illustrates the magnitude of transmission to a large economy. Second, currency flows. Higher global commodity prices and commodity terms of trade improvements can attract capital into Brazil and support the real, BRL. If oil and related commodity prices rise, the real could appreciate versus the dollar as exporters receive stronger foreign exchange inflows. That appreciation has trade-offs. A stronger currency helps control imported inflation, but can pressure export competitiveness in non-commodity sectors. Third, domestic fuel prices and inflation. Global oil and freight shocks tend to pass through to domestic gasoline and diesel prices. In Brazil, that raises transportation costs across supply chains and therefore pushes up headline inflation. Higher inflation may erode real wages and consumer purchasing power, even as commodity exporters gain. Fourth, monetary policy reaction. The Central Bank of Brazil, or BCB, must reconcile 2 forces: inflation pressures from higher fuel costs and potential capital inflows supporting the real. If inflation rises, the central bank could delay or reduce planned interest rate cuts. Conversely, if capital inflows are large and the real appreciates, that could create room for more dovish action. The most likely near-term outcome in a sustained geopolitical shock is a delay in easing. Central banks prefer to avoid loosening into an inflation acceleration. So Brazil's Selic rate path may shift, with cuts delayed or smaller than previously expected until inflation signals stabilize. Across these channels, the key point is this: even distant countries feel the impact because oil and shipping are global public goods. A disruption in the Gulf does not stay local. That brings us to practical advice. If you cannot control geopolitics, you can control how your portfolio is positioned. I'll lay out a conservative, repeatable framework, the ARCA approach, then explain tactical options for energy exposure. ARCA is a simple 4-part diversification framework meant to keep risk manageable while allowing for tactical positions. Think of it as A. Allocation to equities. Diversified exposure to domestic and global stocks for growth. Are real assets, commodities, real estate, and direct natural resource exposure that often perform well in inflationary or supply shock environments. C. Cash and cash-like instruments, liquidity to meet short-term needs and to provide dry powder when opportunities arise. A. Alternatives, strategies that are uncorrelated to traditional markets, including hedge funds, private equity, or specific tactical commodity plays. The idea is not to promise returns, but to manage risk. A hypothetical long-term split might look like 50% equities, 20% real assets, 20% cash, and 10% alternatives. Those weights are illustrative. Your allocation should reflect time horizon, risk tolerance, liquidity needs, and local tax or regulatory considerations. Rebalance regularly. A rule of thumb: restore target weights annually or whenever an allocation deviates by more than 5 percentage points from its target. Rebalancing enforces discipline. It forces you to sell some winners and buy underperformers, an important safeguard in volatile times. Tactical energy exposure can be part of the ARCA framework but should be sized conservatively. If you have a high conviction view on energy producers because of persistent supply risk, consider adding a tactical sleeve of 1-5% of liquid portfolio for speculative positions and up to 5-10% for stronger conviction, depending on risk tolerance. Always set a stop-loss and a predefined profit-taking plan. Energy is cyclical and geopolitically sensitive. The window to profit can be narrow and unpredictable. A concrete, illustrative example helps. Imagine 2 investors during the recent shock. Investor A had a concentrated position in a single high-volatility asset, for example, a large exposure to a cryptocurrency. Over a 2-week period, that position fell 20% when risk aversion spiked. Investor B was diversified across ARCA, equities, a small allocation to energy producers, real assets, and cash. Investor B saw portfolio volatility but only a modest pullback, perhaps 3.5%, because the real assets and energy exposure offset part of the market drop. The point is not to present ARCA as a hedge that always works. It's to show that diversification cushions idiosyncratic shocks and preserves optionality. If you do take direct positions in energy producers, consider these guardrails. Limit single equity exposure, favor diversified energy ETFs or baskets over individual names if you lack company-specific conviction, and be explicit about time horizon. Are you trading a short-term spike or investing for a longer-term supply-demand imbalance? Also be mindful of company-specific risks. Sanctions exposure, refinery access, and balance sheet health matter as much as crude prices. Risk management extends beyond asset choice. Set position size limits, consider option strategies for insurance, like buying put protection, and maintain liquidity equal to at least several months of expenses, so you're not forced to sell into a market panic. Finally, keep an eye on correlation risk. In systemic events, many assets become correlated and move together. Diversification helps but does not eliminate systemic risk. Let's step back and synthesize the answers to our central questions. What ignited the conflict? In short, a reported highly coordinated operation targeted Iranian leadership nodes and critical infrastructure. That operation appears to have been designed to degrade command capability and deter further hostile activity. Iran's network of proxies and regional alliances, established over decades of political conflict and strategic calculation, converted that operation into a much wider set of attacks. The region's interlocking security dynamics mean that a high-value strike can quickly cascade into attacks on partner countries and infrastructure. Could it affect other countries? Yes. There are clear, understandable channels through which a regional confrontation affects distant states. Energy choke points such as the Strait of Hormuz, shipping and insurance disruptions that raise freight costs, commodity price shocks that pass into inflation, and capital flow shifts that affect exchange rates and monetary policy. The severity of impact abroad depends on scale and duration. A brief, contained exchange will cause short-term price volatility and localized risk premiums. A protracted conflict with sustained sea route disruptions could meaningfully affect global GDP growth and inflation rates. So what should you watch, and what should you do? Watch the choke points and the insurers. The key early indicators are shipping lane closures, the level of insurance war risk premiums, and whether major export terminals are physically shut or widely avoided by ship owners. On the financial side, watch oil futures curves, freight futures, and sovereign bond spreads in affected countries. Politically, watch whether great powers explicitly commit forces or resources in a way that makes escalation more likely. Act with a playbook. For most viewers, that means practical steps. Ensure emergency liquidity, review position sizes, and explicitly decide whether you are trading geopolitical volatility or repositioning for a longer-term change in risk premia. Use a disciplined diversification framework, ARCA, to keep risk manageable, and size tactical energy exposure modestly with clear entry and exit rules. If you hold equities with significant trade or revenue exposure to the region, consider hedging foreign exchange or commodity exposure rather than selling core holdings impulsively. A few quick hypothetical scenarios to keep on your radar. Contained escalation, limited retaliatory strikes and rapid diplomatic de-escalation. Markets overreact for days, then calm. Energy spikes are short-lived. Central banks likely resume prior paths after a brief pause. Intermittent harassment, repeated attacks on shipping and secondary infrastructure without full-scale war. Insurance costs and freight rates remain elevated, keeping inflation higher for months. Some central banks delay rate cuts. Exporters benefit, importers suffer. Protracted escalation, wide-area strikes, extended closure or danger around Hormuz, and broader mobilization by external powers. This is the low-probability, high-impact scenario where commodity shocks and supply chain disruptions reach deep into global growth. Policy responses become more aggressive and chaotic. I'll end with two practical reminders. First, the historical record shows that geopolitics has persistent effects, but also that markets are forward-looking. Prices reflect expectations about supply and policy. That means staying informed and flexible is more valuable than betting everything on a single headline. Second, any investment move should be proportional to your goals and risk tolerance. The frameworks I described are designed to help you make decisions with discipline, not emotion. If you want a deeper walkthrough of the RC framework, model portfolios, and a step-by-step checklist for sizing tactical energy exposure, there's a link in the description to a longer guide and some educational resources. This material is informational and educational only, not financial advice. Do your own research and consider consulting a registered advisor before making significant portfolio changes. In short, the conflict was ignited by a targeted, coordinated operation within a decades-long contest for influence. Yes, it can and already has affected other countries through energy routes, shipping lanes, and market psychology. The scale of those effects depends on how long disruptions persist and whether key choke points remain at risk. For investors and citizens, the answer is preparation, disciplined diversification, and clear rules for when to act and when to wait. If this breakdown helped you untangle the mechanics and the market implications, subscribe and check the description for the deeper resources I mentioned. I'll keep tracking developments and bringing you analysis that ties geopolitics to real economic and portfolio consequences. Thanks for watching. Stay informed and stay prudent.